Welcome to This Explainer. Today, we are tearing into the Q1 fiscal 2026 results for BJ's Wholesale Club. But more importantly, we're going to dissect the anatomy of their highly efficient business model. Whether you're a frequent bulk shopper or just curious about how large-scale retail works, you'll definitely want to pay attention to how they build this incredible structural advantage.
Now, before we get bogged down in the heavy financials, I want you to focus on just one number: 90%. That is BJ's tenured customer renewal rate. Think about how hard it is to get 9 out of 10 people to agree on literally anything, year after year, let alone pay a recurring fee just for the right to walk into your store. This single percentage point is the highly predictable engine fueling a multi-billion-dollar retail empire.
To figure out exactly how they pull this off, here's our roadmap for today. First, the Warehouse Club advantage. Second, the membership engine. Third, the Q1 2026 financial snapshot. And finally, their strategic growth and expansion.
All right, let's jump right into Section 1, the Warehouse Club advantage.
So, BJ's is navigating a colossal $5.9 trillion U.S. retail market. But to really wrap your head around this, you have to think about the physical scale of these places. When you walk into a BJ's, you aren't just walking into a store, right? You're stepping into a massive, highly optimized distribution center that they actually let customers visit. And it is a huge pie. The U.S. warehouse club market all by itself is a $337 billion industry. And to win here, you literally have to strip away everything that doesn't add direct value to the shopper.
That structural advantage comes from ruthless operational efficiency. By carrying a tightly limited number of items, or SKUs, they drive massive scale and insane inventory turnover. Products are often left right on the wooden pallets they shipped on. That means way less labor is needed inside the club just to stock the shelves. Combine that with highly efficient distribution and lower build-out costs per square foot, and what's the result? You get the power to offer prices roughly 25% cheaper than your typical grocery store.
So you might be wondering, does this bare-bones model actually win market share? Oh, absolutely. If we look at the 5-year compound annual growth rate from 2020 to 2025, BJ's sales grew at 6.5%. That beats out the broader grocery sector at 6.0% and totally crushes total retail growth, which was just sitting at 3.6%. So yeah, this model isn't just surviving, it's aggressively stealing market share.
Okay, let's move on to Section 2, the membership engine. Now, what's really interesting here is the secret sauce. Membership fee income is basically a highly predictable annuity for this business, and it has grown consistently every single year for over 25 years. Since 1997, through recessions, global pandemics, and wild shifts in consumer habits, this revenue stream has just relentlessly climbed. And that's exactly what subsidizes those rock-bottom prices on the floor. But why do millions of people keep paying it? Well, here is the big so what you should take away from this. BJ's currently boasts over 8 million members. Because of all those operational efficiencies we just talked about, members get roughly a 10 times return on their annual fee in the form of pure savings. Honestly, when you're saving 10 times what you pay, that 90% renewal rate we mentioned earlier makes total sense. The value is actually so obvious that 42% of members go ahead and upgrade to the more expensive, higher membership tiers. It's this brilliant, self-sustaining feedback loop of value and loyalty. Shifting gears now to Section 3, the Q1 2026 financial snapshot. Before we run through the scorecard for the 13 weeks ending May 2nd, let's humanize these numbers a bit with a quote from CEO Bob Eddy. He stated that their momentum reflects their, quote, focus on delivering value and convenience for the families who depend on us. And that's a really great reminder. Behind all this complex supply chain logistics and EBITDA margin talk, there are everyday families just trying to stretch their budgets. When the company hits the mark on that core mission, the financials naturally follow. And man, the financials definitely followed suit. Net sales for the first quarter hit $5.5 billion. That is a very healthy 9.9% top-line jump compared to the exact same quarter last year. And even if you strip out the totally unpredictable, volatile impact of gasoline prices, their comparable club sales still ticked up a really solid 1.5%. Moving to our next rapid-fire metric. Remember that all-important membership fee income? Well, it jumped to $132.4 million in Q1, which is up another 9.9% from the previous year. This is absolutely crucial to understand because membership income is essentially pure, high-margin profit. It drops straight to the bottom line, giving them a massive amount of financial flexibility. And that brings us right to profitability. Adjusted EBITDA rose to $298.1 million, a 4.3% increase year over year. What this proves is that the business isn't just generating empty revenue, right? They are efficiently converting those raw sales into solid, tangible profits. Plus, they're doing all this backed by a rock-solid balance sheet, which lets them return a serious value to shareholders, like the $207 million they spent on share repurchases just in Q1. Now, this next metric brilliantly illustrates how modern retail is evolving right before our eyes. Digitally enabled comparable sales grew a staggering 28%. Now, you might hear digital and assume people are skipping the warehouse entirely, right? But here is the fascinating twist. Over 90% of these digital sales are actually fulfilled right there in the physical club. Members order on the app, and they drive to the store to pick it up. It's a massive, highly effective synergy between digital convenience and physical infrastructure.
Finally, let's look at Section 4, Strategic Growth and Expansion.
So what exactly do they do with all this forward momentum? Well, in Q1 alone, BJ's generated $140 million in operating cash flow, and they are aggressively pouring that cash into expanding their footprint. They are currently on track to open 25 to 30 new clubs over a 2-year period. They're pushing into entirely new territories, including opening their first ever club in Texas, which proves this momentum is definitely not geographically locked.
Looking ahead through fiscal 2026, management's guidance remains super confident. They expect non-gas comparable sales to grow between 2 and 3%, with adjusted earnings per share landing around $4.40 to $4.60. But honestly, the biggest takeaway here is the massive bet they are making on themselves. We're talking about an $800 million capital expenditure earmarked specifically to build out those new clubs and heavily upgrade their distribution network.
And that leaves us with a really compelling question to ponder. As digital fulfillment continues to accelerate at a breakneck pace, growing 28% in a single quarter is wild. How will the giant physical warehouse club model evolve to maintain its structural advantage in the future of retail? When your biggest asset is a giant physical warehouse, but your fastest growth is happening on a smartphone screen, the intersection of those two forces is going to define the next decade of corporate strategy. Thank you so much for joining me for this explainer, and keep questioning the mechanics behind the businesses you use every day.